Hello, good day. This is Maricar, and what I'll be presenting for you today is NetSuite's Advanced Revenue Management feature, also known as the ARM. The key purpose of my presentation for the day is first, to discuss the key benefits of the ARM module into your business. Next is I will run a quick demonstration on how this feature works. The key benefits of implementing this feature into your business is that first, it eliminates hours spent by revenue accountants in managing revenue manually through spreadsheets. Second, it gives users a clear view on the actual revenue impacts and the updated expected revenue picture for future periods. Lastly, it efficiently meets the revenue recognition standards. Examples are IFRS and GAAP to be able to generate financial reports accurately. All right, now that I have discussed this with you, the next thing now is I will now run a quick demonstration on how this feature works. The first record which we need to set up once the ARM module has been enabled into your account is the revenue recognition rule. So the revenue recognition rule defines how recognition plans are generated after a revenue element is created. Take note that the terms and months that I have selected in here is 6, meaning that the revenue will be amortized over a 6-month period. After creating your revenue recognition rule, you will now be creating your sale item. I have created this non-inventory item for sale, and if we go under the revenue recognition amortization subtab, you would see that there are two fields in here called revenue recognition rule and revenue forecast rule. I have selected two different recognition rule for these two fields. I have selected 6 months for the revenue recognition rule field and straight line 8 months for revenue forecast rule. I will show you how these two are different later on. Something to take note as well when you're setting up your item record is the so-called direct revenue posting field. So take note that if this field is marked or if this field is checked, your transactions or your sales transactions will be automatically posted to your revenue account and there's no need for you to amortize your revenue. All right, so after creating your item record, let's now create your sales transactions. I have created here an invoice record wherein I have associated the earlier item which we have created. If we go on the GL impact, you would see that this transaction has an effect on the deferred revenue and then it was not directly posted to your revenue account. Okay. So once your sales transaction has been posted or if it has been approved, the system would now create the revenue arrangements for you. So there are two options for you to generate the revenue arrangements. First is you can manually trigger it by going to transaction, financial, update revenue arrangements, and revenue recognition plans. The other is you can wait for the system to automatically create for you for every 3 hours. Okay. So for you to view the revenue arrangement records, you go to related records, revenue arrangements, and then if you click on here, you would be redirected to the revenue arrangement record. A revenue arrangement record is a non-posting transaction that records the detail of a sale for purposes of revenue allocation and recognition. Under the revenue arrangement record is the so-called revenue element. The revenue element is based from the number of lines from your transactions or from your source transaction. If we go further to the right of your revenue element, you would see in here the revenue recognition plan. Take note that there are two revenue plan types which were created. First is the forecast and the actual. So take note that the revenue recognition rule follows what has been set up from the item record. So the forecast is just created for the purpose of reporting and it doesn't have any accounting impact. It is the actual, which is used by the system to create your revenue recognition rule, rather, to be able to create your revenue recognition journals. Let's click on the actual, and you will see here all the revenue or the scheduled revenue for this specific plan. Okay, now that we have already created the plan, the next thing now is we will now be creating your journal. So to create your revenue journals, there are two ways. You can do it or you can trigger it manually by going to transaction, financial, schedule revenue recognition entries, run now. Or you can create a schedule and then the system would automatically create the journals for you based on the schedule which you have made. So for this example, I will show it on how to manually trigger the creation of your journal. Okay, so let's change the posting period to December, and you would see that these are all the revenue plans under the subsidiary parent company, which are for recognition for the month of December. So if we click on Mark and click on the Create Journals, let's wait until this process has been completed. Okay, and for you to view the created journal, let's go back to the invoice, go to the related records, revenue arrangements, and let's open again the revenue plan. Let's click on the actual, and you will now see here that the December journal has been generated already. Okay, so that is the summary, or that is the end-to-end process on how the ARM feature works. And as to reporting, all the reports which are related to your revenue can be found under reports and revenue. And something which is very beneficial for the users is the deferred revenue reclassification activity. This report shows how much is the original deferred revenue which was recorded and then how much has already been recognized. And that's it. So that's a summary of my presentation for the day. Thank you.